All right, let's kick off. Thank you to everyone for joining us today. We've got a great webinar ahead. Of course, our monthly business risk review for May, looking back at May. Plenty happening, obviously, with JobKeeper now well and truly behind us, but still plenty of synthetic liquidity, as I like to call it, in the market and coursing through the economic veins of Australia. We've seen some really interesting stats out from NAB recently, in particular their business confidence survey that they release, and business confidence at an all-time, or actually I won't say at an all-time high, but it's significantly up on where it was previously, which is fantastic. We've run a number of events in recent months, what we call our roundtables, with up to sort of 50, 60 clients, partners, and also prospects and companies of all sizes, and it seems to be the genuine consensus is everyone is in a really positive space, feeling good about the economy, and of course positive about the future. They're hiring more, they're starting to invest as well. So really good to see that. There's plenty of other economic stats coming out. I'm pretty sure the turnover came out today from the ABS as well. I had an email just as we were kicking off the webinar today. So a little bit about CreditorWatch as always. We have an end-to-end credit management platform or suite of products. I certainly encourage you to have a close look at this, or speak to your account manager, or get in contact with us to get a better understanding of how CreditorWatch can help your business, whether it is simply introducing credit reporting and monitoring and alerts on your debtors, the first sort of thing that every company should be doing if they're providing any sort of credit to customers, but also the ability to start looking at the next step up from there. Still very simple, fast and easy to integrate. Apply easy, of course. Do away with your paper-based credit applications. Start using an online credit application. It is a much better customer experience for your customers and prospects, rather than having to fill out a paper-based form or a PDF online and then emailing, scanning, sending it in. Get real-time answers for them. Much better experience for yourself, for your team, and also for customers, importantly. And a big topic of late, we ran a webinar, was either last week or the week before, around PPSR. So that's on the right-hand side here. We have a product called PPSR Logic. If you're offering trade credit, if you're offering finance, and you're not registering on the PPSR, you are missing out and doing yourself a disservice. It can be complicated. There are plenty of businesses out there that don't believe in it. What I would suggest is you definitely get in contact with us and have a chat to our expert, PPSR Paul, and if need be, we can refer you on to others as well around that. But it is definitely something that you should be considering taking up. It's extremely important, and when the proverbial hits the fan, it is a really powerful tool to have in place to ensure that you get paid or you get your goods back as well. So have a look at ppsrlogic.com.au or get in contact with us and we can help you out. Key highlights. So I like to use this slide as a way of justifying the rest of the webinar, the rest of the presentation, the numbers we're talking about. How can I sit here and talk to you about insights and stats and trends and whatnot? The fact is we get a huge amount of data coming in from dozens of sources, including ASIC, Australian Business Register, the ATO, insolvency notices, and then of course our huge customer base who are lodging payment defaults against their debtors. A really powerful way to find out if a company you're doing business with is stop paying their bills elsewhere. Of course, we also have a huge amount of trade lines as well. So that's invoices, essentially from age trial balances, Xero and MYOB, allowing us to see how a business pays their bills, right? If you're about to offer credit to someone and you have the ability to see that they pay on average 60 days overdue, is that going to change your credit assessment? Is that going to change how you deal with them? Maybe you'll just put them on COD or 50% upfront. As I said, it's a very insightful metric to use to know and plan. Maybe you're happy with the 60 days overdue, at least you can plan to it from a cash flow perspective. quick agenda there. I'll touch on what the business risk review is, and then we're going to look through some payment defaults, external administrations, court actions, all the normal things that we usually talk about during the business risk review. Kind of touched on this already. You can see the stats that we, the sources that we pull data from, aggregate it all, anonymize it, and we start to report on an industry level, a payment default level, a national level, all those sorts of things. And we do have some exciting news that we will have a new payment rating system in place in early July. So if you are a CreditorWatch customer and you're using the payment predictor, you will see that has been significantly, or will be significantly upgraded in early July. And we will be moving more towards a payment rating system similar to our new risk score that went live probably 12 or 18 months ago now. Really gives you a better understanding of how customers are paying their bills and allows you to be a little bit more predictive with how you deal with them, particularly when opening or assessing accounts. First one to look at, so this is something that we have been talking about for some time, and I'm certainly on the record in the media talking about it as well. The fact is that we know that payment defaults and administrations, which we will look at in a little bit later on in the webinar itself, have been at record lows for 15 months or so. So basically, March is really when COVID started to hit. March, April is when JobKeeper and insolvency safe harbor legislation came into play. And what we've seen is a huge reduction in the number of payment defaults. What are we seeing, however, for the last month? May, we've seen an increase on April, so almost 10% increase from April to May. And however, if you look down at the second stat, you can see we're still well down on where we were even in May last year when COVID was really starting to bite. So payment defaults simply haven't come back. Why is that the case? Look, the reason is there's a huge amount of money that's been pumped into businesses in the form of JobKeeper and other, tax and employment sort of stimulus that's around. Plus, consumers are cashed up as well and spending money, and the economy's in a fantastic position, which is really, really, really beneficial to businesses. It means they've got money to pay their bills. Plenty of examples and discussions amongst the debt collection community that people have been paying off their debts that have been outstanding for quite some time due to the cash positions of both consumers and commercial entities as well. However, we know that those numbers need to start moving back towards pre-COVID levels, and we are starting to see that very briefly in that 10% increase from April to May. We are expecting to see a sustained increase over the next 12 months back up to those normal numbers that we saw. It certainly shouldn't be rise for concern. The fact is that companies do go out of business. Companies are slow to pay their bills or don't pay their bills. That is the nature of a capitalist society. That is the nature of business. The cost of business is, if you are going to offer trade credit or credit of any sort, you know that there is a certain portion of that you will not get paid. And if you're operating on COD, you don't have to worry about that, of course. But if that's the case, you're probably not very interested in this webinar today. So we are expecting to see that continue to increase. I think there will be blips along the way where it comes down a little bit, but overall, if you looked at the next 12 months, we will certainly start to see it increase back up to its pre-COVID levels. So this is going to be a really important metric to keep an eye on. The one thing I failed to mention at the beginning, please do ask questions. I will have a bit of time at the end of this to answer any questions that you might have. So jump in the GoToWebinar control panel and ask those questions as we go along. The next one we look at, and this is a really positive sign that we're seeing. What we saw, if you went back to April 2020, which is just obviously not showing on this, we've got May 2020 is the first one. Credit inquiries really fell off a cliff from their pre-COVID levels. We saw it come down significantly in April. We saw it build back up over May, June, July, even August, and then it came back off again as the Victorian lockdown really started to bite. naturally, you have December and Jan that are much lower than usual, and that's a total. This is obviously not adjusted for seasonality, but you see December and Jan come down as less business and trade is taking place. But what we've seen that's really positive is a really big jump from February onwards, keeping in mind Feb is a short month, which does make a difference. Those 2 or 3 days shorter than the rest of the months makes a big difference. And we've seen a jump there to almost a record level above the sort of top COVID affected month. March, a huge jump, which is really good. March is for me the favorite month of the year. Everyone gets back to work after a slow sort of November, December, Jan, and of course Feb being the shorter month. We did see it drop back down in April. However, it certainly didn't drop back down to sort of those COVID levels. And again in May, we've seen it increase again, which is really great. Credit inquiries are certainly what I would call the sort of heartbeat of trade, right? And this is both trade credit and also finance related credit inquiries. It's also companies using CreditorWatch to assess existing customers. So it's not all new business. There's certainly companies out there, or our customers are out there assessing their existing customer base to get a better understanding of the position of those customers. What we know is plenty of companies out there cut credit limits significantly or stopped offering them altogether. And then what we've seen is an increase over time where they're getting more comfortable with the position of the Australian economy, getting more comfortable with their customers, and therefore they're starting to increase those credit limits back up to where they were before COVID hit in early 2020. So really positive that these credit inquiries are continuing to rise. Again, we expect this to remain at these levels, if not continue to increase somewhat as well, as everyone becomes a lot more comfortable. It'll be interesting to see, how June plays out with the Melbourne lockdown. Of course, we've had 10 days of it. They should be coming out in a sort of staged approach from this evening, which is very positive. So obviously, as always, thinking about our Victorian friends down there, and hope you are keeping well as can be. Probability of default. Now, this is a newer slide, a newer stat that we've started reporting on, where it looks at the probability of default for a particular industry. Now, there's probably no real surprises here. That it does move from month to month, which is important to note, and we haven't yet started to measure it against the same month in the previous year. However, it does a really good job of sort of ranking the risk essentially of the various industries that are out there. What we know is accommodation, food services traditionally is a riskier industry than most. Combine that with the fact that we're in the middle of a pandemic where they're either shut, restricted, or have limited numbers coming into their venues, and then we have essentially the whole of Victoria shut down, putting a huge amount of pressure on those cafes and restaurants and bars and whatnot, and also just hotels, of course, being very underutilized as a result of a lack of international tourism. And on top of that, we hear that there are plenty of hotels out there who are struggling to get staff, that they can only operate at a capacity of sort of 60-70% because they simply don't have enough staff to actually go above that, which is a real shame after they've done it so tough for so long. So accommodation, food services, transport, post and warehousing, they've done it extremely tough through COVID and still remain quite high. Anything over sort of over 5% in particular is a worry. And of course, if you run a credit report in CreditorWatch, whether you have to buy a credit risk score or it's included in your subscription, you would see the probability of default against the individual company that you are looking at, right? So what we do is we obviously combine that at a industry level. So please note that you can then have a look at an entity level probability of default by reviewing the risk score in there. Also gives you a fantastic risk rating to give you a better understanding of where they're sitting, and almost a recommendation as to how to trade with those particular entities. Public admin and safety, administrative and support services, information media technology, information media and telecommunications, professional, scientific and technical services sort of round out the top 5 or 6 there. The next 2 there, construction and retail, are performing quite well. Retail, again, often a higher risk industry to deal with. What we know now, though, is that those with a decent e-commerce solution are performing much better than those that don't. Single stores reliant on foot traffic in the CBDs are obviously struggling quite a bit as a result of a lack of foot traffic, people not going into the office, etc. Construction, one that seemed to perform quite well through COVID. However, there's a couple of question marks next to that. The feedback we get is actually that construction industry companies are paying their bills really well. They're not seeing this sort of slowdown in payments, for example, or an increase in administrations. However, we know typically that construction are one of the riskier industries as well. Court actions are still down significantly, even on May last year. The fact is that the banks and the ATO, who are typically 2 of the biggest plaintiffs in the court action world, are extremely gun shy, is probably one way to put it, or they are extremely sympathetic to the challenges that businesses are facing out there. Is a better way to say it than gun shy. They are being sympathetic and supportive. That whole Team Australia notion certainly exists within the banking system, though we are starting to see a slight uptick in the number of banks that will commence court action proceedings and ultimately wind up an administration in the near future, as they have a better opportunity to start to review customers and companies and to assess whether they'll actually be viable in the future, or if they're sort of burying their head in the sand and not responding to requests for information. You'll start to see the banks get more aggressive before the ATO does. The ATO is still extremely quiet from a collections process. They are they're probably the single biggest plaintiff in the country. They have said that they are commencing their collection activities again, which most people would know about, but it's certainly a very gentle, softly approach at this stage. Call me cynical, but I do not see the ATO becoming or getting back to its normal sort of collection rhythm and cycle that we saw pre-COVID. Not that it was any more aggressive than in previous years, but we probably will not see that until after the election, after the next election. Of course, we're in an election year. The last thing the government probably wants is the ATO going out there winding up businesses that owe significant amounts of money. Not a great way to win votes. However, as creditors, we all know that there is nothing worse than having a debtor, having a customer go into administration when they seem to be paying you and your competitors and whatnot fairly well, only to find out that they have a significant tax debt that no one had any idea about, and ultimately has resulted in the ATO winding them up as a result of that tax debt. So I think the ATO plays a very important role in keeping those companies honest. The last thing we want is the ability for those companies that owe the tax a huge amount of money, the tax office a huge amount of money, to continue trading beyond their means and potentially racking up debts with other businesses that are completely unaware of those tax debts that are increasing. In good news, the ATO will hopefully be sharing ATO tax default data in the future, which will obviously be a great indicator and a great piece of data to have within CreditorWatch credit reports. External administrations, ultimately they were the single most spoken about, reported on credit risk flag over COVID. Everyone wanted to know how many zombie businesses are out there. When are we going to see that huge wave of insolvencies? We're so fortunate that we are ultimately not going to see them. There's been some ups and downs along the way, and of course December there was a big increase there, but still ultimately we are well below the normal pre-COVID numbers of, you know, between sort of 750 and 850, sometimes 900 a month. Despite this, we have seen, you know, a couple of increases. March, we saw a bigger increase, and May, we've now seen another increase as well. Similar to defaults, we expect a sustained increase in the number of administrations, but ultimately banks and the ATO and ASIC, for that matter, will be the ones to determine exactly how soon we see bigger increases back up to those pre-COVID numbers. Just to give you a bit of background there, if you compare May 2020 to May 2021, we are down 6.5%, and May 2020 was probably about 30 or 40% down on May 2019. New South Wales still, as always, contributing the most number of administrations on a state-by-state basis. It will be interesting to see how Victoria fares over the next sort of 3 to 6 months, and whether the latest lockdown, I believe it's the 4th lockdown that they've endured, has an effect. We know that it takes time for administrations to ultimately filter through and actually become official. So we won't see a spike immediately, but definitely keep an eye out July, August, September to see if the percentage of, and maybe that's a stat that we can include in here, is their share of voice in terms of the percentage of administrations, and whether that is increasing on a year-on-year basis. So as I said, I wanted to make sure that we did have time for some questions. So I'm just going to jump in and have a look to see if any have been asked. Great, we've got a few in here. Give me 1 second. Just a good comment here. There is an article on the ABC that shipping cost surge raises retail price pressures and inflationary risks. With the global supply chain issues going on, what is your take on the business sentiment for the next 6 months? Yeah, that's a really good question, and it's something that's been in the media quite a bit of late. I think a 40-foot or 50-foot shipping container, the cost of that has increased something like 3 times in the last 12 or 18 months, putting a huge amount of pressure on not just costs, but businesses that rely heavily on importing goods or even exporting them, to be honest. What we will likely see is that businesses that don't have the ability to obviously pass that cost on in an economical way will certainly be put under more pressure. Consumers will be hit with price increases. We will see potentially inflation increase, but I don't want to get too much into that because it's certainly not my strength. But there's been plenty written about inflation rising, and then of course how the RBA deals with that, given they've kind of locked in interest rates for the next 12 to 24 months. The other thing to go with that is not just the increase in the cost of shipping, but also the time frames to get goods in. We've seen huge blowouts in time frames for shipping to actually land back in Australia. So if you're a business that's reliant on goods to be shipped in so you can sell, or parts to be shipped in, semiconductors are the hot topic at the moment. That puts a lot of pressure on your business to actually be able to have anything to sell. For example, I would love to buy a new road bike, and essentially there's no supply out there whatsoever. And when you talk to the various stores, I'm in Sydney. Anyone who knows Clarence Street or rides a bike knows that there's 3 or 4 along Clarence Street. They're all saying the same thing. They don't have access to parts, very important parts like gears and brakes, and even one of them was saying that they're struggling to get enough boxes. These are the manufacturers, boxes to actually put the bikes in. So there's this huge delay, and they don't actually have a date for you as to when those new bikes will be available. You're talking sort of 6 to 12 months, which is just seems insane when there's this huge demand for it. They can't actually keep up with supply, and one of the challenges is those goods are either not available to actually make, the parts aren't available to make that product, or you've got these huge delays in shipping as well. Question here, I would have thought arts and rec services would have a similar default probability as accommodation and food services. I can't remember exactly where it was, but that was certainly been one of the riskiest industries. Let me just go back to it so I can talk to that at the same time. Arts and recreation services, yeah, certainly down there, the second least risk. That's a very good point. I think something to say would be to keep an eye out on what it has been doing, so we can jump online, or I can provide some historical ones. Arts and rec services have certainly been one of the riskier industries that operated through COVID for obvious reasons. At this point, however, it's not showing that same sort of risk. But as I said, these can certainly change from month to month, so I will keep an eye on that, and I would suggest you do the same. A question here, it's very, very specific, so I'll just mention it, but I'll have to come back to you on this one. Are you seeing any impact on flow on businesses yet regarding liquidation of Pindan Group? Unfortunately, no, not off the top of my head. It's something that I have to look closer at, but potentially I can come back to you on that with some more information once I have a look at exactly what is going on there. But nothing has jumped out to me at that point. We might leave it there, conscious of time. The feedback we've got from listeners is they like to try to keep it to that 30 minutes so they can get back to work or enjoy their lunch break. I just wanted to say to everyone, thank you very much for your time today. As always, I encourage you to jump on the website and have a look at other information to go through it. And I think Ross Lambie, so the Australian Chamber of Commerce and Industry, provide a presentation to a recent roundtable that we did. I strongly suggest you jump on and have a look at his views on the fiscal outlook. It was a really good presentation that he put together. Certainly a much smarter person than I am, and the ability to talk about economics and the economy and the future of the economy in a really easy to understand way, which is good. And of course, within the blog as well, we have our business risk review for May. You can jump in there, have a look at a few more stats, read the media release, and our own chief economist, Harley Dale, has got his opinion in the bottom of that webinar as well. The last thing I will do before I wrap up, as always like to do, if you would like to be contacted by CreditorWatch, please do let me know. Just a quick response there, and if not, that is fine. You can say no, or you can jump off the webinar, because we are done for today. Thank you all for joining us. I really appreciate it. I hope that you join us for our next webinar. We have one coming up on Phoenixing in a couple of weeks that you should receive an email for early next week, mid next week, I believe. So great webinar, very topical. Phoenix activity will certainly increase over the next 12 to 24 months, arguably. And we've got Peter Gosnell who's an ex-journalist and is now the publisher of Insolvency News Online, and Jeanette Muller, who is a registered liquidator from Hall Chadwick, I believe. So they'll be joining us. I will be moderating and getting their thoughts on, what is it, how is it affecting companies, what should we look for, and some tips and tricks, as well as some case studies on bigger versions of or bigger events of Phoenix activity that we've seen in the past. All right, thank you all again. I will wrap up now. See you next time.